All right, the open economy, international trade and finance. Welcome to capital flows and balance of trade. All right, so we have within the balance of payments, what we're looking at is we want to see how money flows from one country to another country, in which goods and services are being sold, but also financial assets, stocks and bonds and currency are also being sold. So we have two main accounts. There's going to be the current account and the financial account. So to define what the balance of payment accounts are, it's the summary of a country's transaction with other countries. So that's all it really is. All right, so now we're going to look at them a little bit more specifically. So we have the current account and financial account. First, we're going to start with the current account. The current account includes transactions that do not create a liability. If you recall from earlier in the year, a liability is a promise to pay somebody money later on. So these are ones that don't create that. These are transactions that as soon as something is bought and sold, that transaction is over forever. So what we'd be thinking of would be three things. Balance of payments on goods and services, so you buy an item from another country, no liability. You buy it, it's bought, you get the item, they get the money. Factor income and international transfers, and on future slides we'll define each of these three things. Current account, so within that first one, balance of payments on goods and services. What we are really talking about here are imports and exports. So that's what I want you to put next to that for number one. Imports and exports. When we import something, that means people in one country are buying things from another country, so they're bringing it into them, they're importing it. Exports are when we sell something to another country. And so each one of those will affect our balance of payments on goods and services. So we have a trade balance, which is the difference between a country's exports and imports. So when Trump goes crazy about how China's beating us, what he's talking about is we have a negative trade balance with China. So the United States, we import more than we export to China, which is not surprising at all, and it isn't even a bad thing, to tell you the truth. It just means we have a negative trade balance. And we'll see later on in this video how actually that all balances out anyway in the end. But that's all this is. So we can have a positive or a negative trade balance. If we are importing more, then we have a negative trade balance. If we export more, we have a positive trade balance. All right, the second aspect of the current account is factor income. And again, this is a term way back from Unit 2. Four things that are included here: interest, profits, wages, and rent that are earned overseas. So if you're making money overseas, again, these are things that don't create a liability. That's part of factor income: interest, profits, wages, and rent. Then that's going to be part of the current account. As well as international transfers. That's our last one. International transfers, these are the toughest to measure because there's no good or service being bought or sold. So what's happening here is a person might go work in another country because there's better job opportunities there, and then they send money back to their family in their home country. That's a transfer. They don't send their family money and receive some good or service in exchange for it. They just simply wire them or transfer the money to them so that they have money back home. But that's another part that will go into the current account, and it is the toughest to measure because, like I said, there's no good or service actually being sold. All right, now over to the financial account, our second part of our balance of payments. Remember that these include financial assets that create a liability. So that's your fundamental difference. Current account things don't create a liability, financial account do. If you remember that, you'll be pretty good if you remember what a liability is. There's two aspects. They're the same thing. One is official asset sales and purchases. The other is private sales and purchases of assets. And on the next slide, I'll explain the difference between those two things. Official asset sales and purchases are made by central banks and governments. That's what the word official means in this context. So if the Fed were to buy currency from like the euro or the yen or the yuan or something else like that, that would be an official asset sale or purchase, and it would go in the financial account. Private sales and purchases of assets are the same thing. The difference is these are done by private citizens. So buying stocks, bonds, ownership of another company, all of these things create liability, a promise to pay in the future. And so all of these things would go into the financial account. All right, so the best thing about this is it's really, really simple. You don't really have to do any math at all. That term there, it says balance of payments, and what that refers to is that the current account and financial account will always be balanced. So they will always equal each other. So the current account plus the financial account will always equal 0. So if the current account increases, that means that the financial account must decrease by an equal amount. And the opposite is true as well. So another way that we could define this would be to say that the current account is equal to the opposite of or negative financial account. So that's actually pretty simple. So money in equals money out.